All right. Is everyone there?
Got me?
Sorry for that, guys. Sorry to everyone who's tuned in. Really sorry for that. I've got rid of the dog, and look, I think we're ready to get started. So, guys, just a little bit of housekeeping from me. If when we're speaking, if we can just, when we're not speaking, can we just put our mics on mute? We had a bloke a couple of weeks back who was Hey, Grant, is that you? Hey, Grant. Lol. Okay. I just wanted to say thank you for joining me, Josh. Thank you for joining me, Geordie. Thank you for joining me, Nick.
My pleasure. No wuckers.
Beautiful.
No worries.
Beautiful time to be alive. Look, before we jump into it. No, let's just jump into it. So, lads, I think we'll just start with a general intro just to kind of acquaint ourselves with our lovely audience here today. So, Josh, I think I'll start with you. Just maybe age, sex, location, and
wouldn't you want to know?
Yeah, exactly. ASL, and just a little bit about yourself, just to acquaint us.
Yep. So I'm currently portfolio manager at Capital H Management, which is a boutique investment management firm. It's founded by a guy named Harley 3 years ago. Focus on ASX, micro caps, small caps. Currently running 2 funds. One's a high conviction stock picking fund. It's done pretty well over the 3 years. That one's also hard closed, so we're keeping it small so we can try and be one of the best funds in the country, micro caps. And the other fund is a friendly activist fund, where we're trying to find companies where we can come in and be on the board or management or help with strategies and sort of be the catalyst to create value. So it's a little bit of a different strategy there. And then I guess more broadly, I've pretty much known I want to be in financial markets since year 10, where I did commerce and I learned about shares. Simple thinking back then. So take this money and I put it into this and then I just get more money back.
Yep.
Sounds easy. So let's go do a degree in that. And I guess more broadly, I've had quite a bit of experience. So general wealth management, financial planning type stuff, funds rating research, a little taste of consulting there. And then in just regular stock picking through to long short hedge funds.
Beautiful. And what did you study at uni? Did you say that?
I was at RMIT, so I did a Bachelor of Business with a double in Economics and Finance as well. And back when I did the degree, it was when they had a mandatory work placement. So I spent a year part-time working at a broker, learning about energy.
Oh, yeah.
Learned a lot more about energy than finance in that year, that's for sure.
Yeah. What was that like?
It's pretty fun, 2 days a week, doing a lot of grunt work. So it was pretty relaxed. And it was right during the GFC when more people were getting fired from the industry than getting jobs, but when they could pay me minimum wage to do grunt work, made sense for me.
Yeah, get your foot in the door, maybe just be a bit of a sponge.
Yeah, I tried to be as much of a sponge as possible, particularly at the end of financial year drinks. I was a sponge and didn't come into work the next day.
Soaking up alcohol.
Yeah, pretty much.
Very nice. Okay. All right. What was it about year 10? What was it? I mean, I know it was, the idea of, put a stock in, get more stock back or whatever it was, but was there anything else about that class? Like teacher, kind of some of the other themes, like what really, was there anything deeper there about how you kind of gravitated towards the whole concept?
No, I was just a lazy prick, so it sounded really easy, so I thought I'd do that. But when it came to later in the year, I did we did work experience. So I sent this is back when you still sent mail to places. Yeah. So it's looking like 2004.
Yeah.
And I sent a letter to pretty much every stockbroker on the street. So I thought stockbroking initially, essentially, as the process of doing shares, and did a week at ECL Values, as they were called back then, and learned about that. And then that's where I sort of really thought, I want to do something like this in this industry. And just, sounded like a good idea. But the tenant core tenet was very simple, and it turns out that it was an exceptionally wrong thing to view to have.
I think it's a good place.
It turns out it's fucking hard.
Yeah. But I think if you could, because you kind of keep that, you probably keep that core idea or core belief at the forefront of your thinking, and then you kind of like build your skill set around that, right? Like, I don't think you ever. It sounds like you don't ever. It seems like you don't ever really lose that. I guess that childhood ambition. Like, you just kind of like you just add different layers to it and add like more context to it.
Yeah, it's sort of what happened. And then the sector is quite diverse. So there's a lot of different things you can do. So a lot of people obviously gravitate to stock picking, whether you're a day trader through to a long-term investor, but, consulting, asset allocation, manager research, financial planning, wealth management.
Yeah,
there's a bunch
of different
areas
places you can go.
That you can go and find your groove in the space. Investment banking. I thought that was pre-GFC, and I thought investment banking was cool, so maybe do that. But when you get an 85 as your enter score in high school, you're definitely not going to any unis that get you into investment banking, that's for sure.
What do you need for that? Like high
go to Melbourne, Monash, which are like 95 plus hurdles.
Yeah, right.
So
right.
Given the chance to be lazy, I take the path of least resistance. So that was me in high school.
Look, it seems like it's going okay at the moment, though. I mean, bar the last couple of weeks, it seems like the kind of like dominoes have been falling in the right direction generally, though.
Yeah, generally. And you go through hard phases through there as well. So when I had this stint at the long-short hedge fund, that was a really tough year. The fund was down like 35%. So I bit off more than I could chew. Tough year. Just had to go our separate ways. But you learn a lot of lessons getting punched in the face repeatedly over a year.
Yeah, I might come back to that in a little bit, because I think that's something I would like to ask you more questions about. So I think we'll go to Geordie for a little bit and just get a bit of an intro. Geordie, there, sure. Big G Daddy, Big G Daddy. Is that cool if we refer to you as that?
Yeah, do it.
So we got JB and the G. Sorry.
So
all right, continue.
My introduction to markets was when I was like 12 or 13 years old.
Yeah, right.
And I had some savings from when I was at school, and my dad was a geologist, so he was like punting on microcap mining stocks since fucking forever. And yeah, when I was 13, I got one of those E-Trade accounts where you get like the smallest amount of money possible, and you get like a preset 5-stock portfolio with like Rio, BHP, Telstra, Spark,
nice,
and ANZ or something like that. But that was like early September 2001.
Yeah.
And speaking to like what Josh said about just getting absolutely fucked and that being a learning experience.
Yeah.
And like the times where you get smoked and survive are the ones that you learn the most from.
Yeah.
Early September 2001 was about 2 weeks before the planes hit the two towers.
Yeah.
So I remember going to school and seeing all that on the TV and being completely fucking freaked out about what was happening there. And then I like booted up my E-Trade with my tiny little account, and everything had just been destroyed because I sold off massively after that happened.
Yeah. How much are we talking in this account?
Oh, it would have been like the minimum, like 5K or something like that, because I was like 13 years old.
Like,
man, you're rich.
That's what we need to stop for a second. You have $5,000 as a 13-year-old? Holy shit!
I couldn't even count to that many when I was 13.
That's gangster.
But like, and then like I just completely forgot about it for a while. And like when I was going to uni about 6 or 7 years later, had my first job. So like when you get your first proper full-time job, you think you're swimming in money.
Yeah.
So I was like loading up on my 5 stocks, like my Rio, my BHP,
Yeah.
And I found this little gold stock on like a investor newsletter called Gold Road.
Yeah.
GOR.
Yeah.
And it was like 20 cents at the time. And I loaded up in that. I thought I was so clever because I'd read this investor letter.
Yeah, you figured it out. You've cracked the code.
Yeah, I'm killing markets.
Yeah.
And then again, I got smoked because it was like 2007 at the time. 2008 rolled around. My portfolio was like 80% commodities. And the other 20% was this little gold stock that was an explorer and had nothing going for it. So when my Gold Road shares went from 20 cents to 1 cent, and the rest of my portfolio got smoked as well. And I was like, fuck, I should actually probably learn what I'm doing at some point. And Gold Road, when it went to 1 cent, I'm like, all right, so it can't possibly get worse than 1 cent. Like,
yeah,
it's impossible for it to go to zero. So it went back up to 4 cents from 1 cent, and I'm like, oh, this is good. Like, I could load up here.
Yeah.
Yep. No idea what I was doing. There was no fundamental basis for loading up. I was just like, the price was lower a week ago, and it's going higher.
Yeah.
So I think my average for Gold Road was around 14 cents. And then they actually found their main deposit, which turned them into what turns out now to be an ASX 300 company. I think they're like a $1.5 billion company now. So I actually did extremely well out of that gold stock.
So you had them at average of 14 cents. Where'd you get them out?
I think I got them out, or most of them out around $1.40, $1.30, $1.40.
Damn, Daddy.
So that was like my first like real big win.
Yeah.
And then after that, I was like, okay, it's time to actually figure out what I'm doing here.
Yeah.
So.
And when was this? How long ago was this?
I think Gold Road got up to the ASX 300 a couple of years ago. So it was around like maybe 2019. Seems so long ago, but it wasn't.
But you had them from when? Like, how long did you have them? Like 5 years?
10 years. 10. Over 10 years.
Holy shit.
And they went to zero twice in that time.
That's unreal. I love that.
But now, in terms of my strategy, I sort of, once that happened and I started to sort of dig in more about markets and learn more about markets, it was, I started to build like certain portfolios or certain strategies that started to work. So my main strategy is like a long short strategy over like 3 to 6 month timeframes.
Yeah.
And my main other portfolio strategy is like working on like, it's called like the SIN portfolio. So it like works off the 10 different main addictions people have.
Yeah.
It's kind of a really shitty way to try and make money, but it actually works. I found. So there's like 10 different sort of pillars I work on with that one. And I also, after I met you guys, I got sort of hooked on doing intraday stuff as well. So my plan was to do intraday in the mornings and then sort of learn and read markets during the day. And work on my long short strategy there.
Yeah. Well, I think we'll dive more into your Sinner portfolio because I'm interested to know how quickly you're going to get to hell.
It's fucking terrible. Like in terms of, but like it's a good lesson, right? Because if you get smashed in markets enough, you learn to detach yourself emotionally from holding positions.
Yeah.
So if you're someone that gets emotionally attached or gets like, or brings their personal views into things, then markets probably is the spot for you to do that.
Yeah,
in my opinion.
Yeah, I suppose that's the perfect example of it, right? Like you know, because you see so many people talk about these ideas that they have, and they really, I don't know, it's a hard conversation to have, right? Because I think to a certain extent you do have to have, you need conviction. It's almost the same, it almost comes from the same place, the idea of conviction and emotion, like emotionally being invested, but also versus just being confident or just kind of having conviction in a thesis.
Like I see when like people arc up at Nick and Chris on Twitter,
yeah,
about like whatever stock it is, it doesn't fucking matter really. But when they get so pissed off that they need to go and like emotionally abuse people, you're already too deep. Like,
yeah, I agree.
You're either too large, like you've got too much size on, or you're like too attached
to the story.
And if it goes against you, you're
not ready to cut it.
At that point.
Yeah. I agree.
I think it's also probably close to the top when you get that like defensive about it.
Yeah,
because you're probably like in your own sense of feeling, you're like, oh, I'm king of the world right now. My XYZ stocks at all-time highs, and it's just it's gone up 50% in the last 3 days. So you're getting like this confirmation bias that you're right. So that's why you go in super hard against someone who's critiquing it. So I feel like for me and my long-term stuff, I feel like if I ever got like that about a stock that I owned, I would probably like have to check myself and be like, this is the top, you need to fucking sell. Or at least I hope I would
at least sell some.
Yeah, exactly. At least I hope I would have the discipline to be able to like recognize that that sort of thing. So yeah.
And like if you're like, this episode is meant to be about like themes and how you like think of trading ideas for like any time frame. It can be intraday or it can be investing or whatever. If you're so hooked on one thing, you're not going to be able to think clearly to generate an idea somewhere else, in my opinion.
Yeah, and I also think like you're not gonna be thinking through the idea that you do have in its entirety. You're not going to be able to think deep enough and wide enough about it if you're focused on the emotion of it, like falling in love with the story or a certain theme. Yeah, I don't think you can actually think laterally enough to make the right moves at the right time. And I think I think that's. Did you create the SIN portfolio with that in mind? I guess, like, if I got this portfolio,
it's just like studying. If you go, because I got fucked so many times, and I had a portfolio that was just all commodities, and it was all like super cyclical stuff. I wanted to find things that last through the ages and that people would continue to use no matter what happened. So like my 10 pillars, I can read them out for you.
Why not? We're here now. Go for it.
So social media and the internet, so that's a very strong addiction.
Yeah.
Alcohol.
Yeah.
Shopping.
Yeah.
Gambling.
Yeah.
Sex.
Ooh.
Vanity.
Yeah.
Video games.
Yeah.
Tobacco. Weed and coffee. They're my 10.
Hectic.
So in that sex category, is that Simps and OnlyFans fit in there, or not so much with their new strategic direction?
It's a good question. It's a good question.
No,
strong sell.
Strong sell.
I've had Match.com for a while, which is Tinder and Hinge and Match, obviously. So that sort of falls into that category, I guess.
Yeah, nice. What was under Vanity?
So I love the Visa. It's great, but like that was a theme I actually had written down for intraday.
Yeah.
And I think Nick's noticed this one as well. Is retail stocks are just getting smashed when they report at the moment. Like it doesn't matter what the number is. Well, I guess like it sort of does, but there are some stocks reporting some pretty good numbers and they're still getting owned. and Lovisa makes me very nervous. Like, I don't think they're going to report a particularly good number, and I reckon they'll probably get smashed. But Vanity, I have a company called InMode, which they do like micro needling and like fat reduction machines.
Yeah.
So they're like liposuction without invasive surgery, I guess.
Yeah.
And the other one's AbbVie, which is Botox and injectable therapies and stuff.
You're right.
So these companies just like spray cash out. Like they're just amazing cash machines, basically.
Are these all US based?
They're all over the world. So I mainly go US and Europe because they're easier to find, like good ones.
Yeah.
Like everything in the ASX, and Josh would probably like agree with this. Like there's 20 companies or like really good companies on the ASX, and they're all bought up to like massive valuations. Like there's no like meat left on the bone if you buy them. You're just sort of going with the rest of the crowd.
Right.
Yeah, no, definitely ASX gets concentrated like that. And there's a lot of companies that can look very good for 5 or 10 or 15 years and then something happens to them and maybe they get back on track and maybe they don't. So there's always ones that you can ride for a very long time that look good and essentially until they're not. But that's pretty much goes for any stock or company as well.
Beauty. All right. Well, I think we'll shuffle along here because I think, I mean, you've kind of been talking about it there for a little bit, G, but I think I'll dive in here with JB for a bit. In terms of style and process, I'll come back to you, G, just to dive a little bit deeper into it, but we'll go a bit of JB action here. So, yeah, style and process. How was that developed and what does it look like at the moment? I know you mentioned kind of not too much short stuff unless it's kind of to do with like a macro theme. Well,
the process is just to find things that go up. So I have a generalist approach where I'll just look at anything and see if I can work it out and understand it well enough.
But like, let's just say you got a big blank canvas. Like, where do you start? Do you find a sector first? Do you find did you hear a name? Take us all the way back to the beginning. Like, how do you start? What's the first step?
Oh fuck, that's a good question.
You know what I mean? I know
what you mean.
RPM, right? Like, did you just hear that some day? Did you see them on the side of the road and go, oh, I wonder what that is? Or
no, that one was a mix of, you knew the auto sector was doing well. But I guess this is sort of the privilege of being in funds management. We have IR brokers, people like that who will come to you or you deal with, who always have companies they represent. And in microcaps, there's always someone trying to raise money at some point as well. So there's a lot of action. So RPM was essentially brought to me as an idea for a broker, but obviously tracking a lot of companies like I do, you knew the auto sector is a good place to look for ideas as well. So in that particular one, there's a theme there. There's spending, domestic, it fits into a similar retail narrative there, but for them in their business, they also have a very heavy skew to industrial with what they're trying to do. And then you get the roll-up strategy as well. So a really great theme can be roll-up strategy.
Roll-up strategy.
The market prices you at 10 times earnings. You can go buy companies at 5 times. As long as the market always prices you at 10, you'll get an uplift on the earnings you buy. And depending on what sector you're in, maybe you get some synergies. Often you normally don't. Sometimes you'll get them. And then, what people do is you'll go to, auto sector Bapcor. So they rolled up a whole bunch of this part of the auto sector where you're selling all these parts, retail, wholesale distribution. Green Cross back in the day, which was the first stock I ever bought doing bet roll-up. You just buy all these little clinics, you aggregate them, become a big player because you can buy them for much cheaper than the equity market will price your script at. And then you keep doing it until you can't buy enough of these things to maintain a high growth rate. And then you got to go back to more sector orientated growth. And then you get a D rating in your price and all of that. So it's a game of musical chairs in that sense, but it's a great business model when you can find someone and a sector where you can do it effectively and someone who can execute it properly. And then you just got to try and get off before the music stops, essentially.
What do you mean by when you say someone, do you mean like someone to execute it for you?
Yeah, like the management of the company. You know, are they opportunistic? See a fragmented sector? Do they have a fucking clue of what they're doing in that sector? So someone like RPM, Clive and his partner Lawrence, you know, they've been in business for a very long time. They've always been within the auto sector. You know, prior to starting RPM, they had run a number of automotive related businesses, including back when they were in South Africa before they emigrated to Australia. Yeah. And one of those businesses was Opposite Lock, where they bought it, fixed it up, turned it around, grew it. They thought they were getting a great deal selling it to Metcash at 5.5 times. Then Metcash just jammed it into their auto business and flogged it off to Bapcor at 11 times earnings or 11 times multiple. So there's someone who knows how to buy businesses, grow them, turn them around in the auto sector. And, you know, at the time I invested in RPM, their shareholding has been a little bit diluted down because they raised equity to help fund the inorganic growth side of things. They own 40% of the company. So they're just heavily incentivized to make sure they get this right. And when you speak to him, he goes, you know, after the Opposite Lock deal, I just realized doing this in the private space. Sorry, it's the wrong way to do this. I need to be publicly listed and I want to make this money for myself, not for Metcash shareholders or someone else who did that to him previously if it gets rolled into a listed entity. So, you know, business models can be a theme. You know, keep an eye out for companies doing roll-up type strategies in sectors that will enable that to be done somewhat effectively.
Is that a new thing, the roll-up?
Nah, it's been around for fucking ever.
Yeah.
You just find a new sector that can take it and someone brave enough listens and gives it a go. You know, when Green Cross was back in 2012 and, you know, I wrote that up for a number of years, made 3-4 times my money, which was great for a first stock. But sold it out, went to Pet Barn, went retail, it changed the game, and you know there's multiple half on that stock in the space of a month or two. But funnily enough, the other stock I bought the next day, these are like the first 2 stocks that I ever bought for myself, was Casbar Resources, and that was a reverse 10-bagger, as I affectionately call it.
Speaking of 10-bagger, how big are those fucking RPM tires? They're huge.
They're big. Those things cost like 50, 60 grand each as well per tyre. So you whack 4 of those on your big Caterpillar truck or 6 of those on your dump truck.
On your dumpy, yeah.
Your casual dumpy. And so those tyres, they were going out to the big Caterpillar dump trucks down in the coal mines in Gippsland.
In where, sorry?
Out in the Gippsland at the coal mines for the power gen.
Yeah. Holy shit, 60 grand. I mean, it looks like a $60,000 tyre.
Yeah, it's a lot of rubber. And you put 6 of them on a single truck.
Yeah. And how'd it go when you were giving them a kick?
I didn't give them a kick. I wasn't wearing my steel caps.
That would have hurt.
Yeah, it would have. So in terms of other themes, you know, in commodities, you look for macro trends, consumer trends, you know, lithium, EVs, lots of money to be made trading stuff like that, health themes.
What's a consumer trend?
Like, you know, not one I participated because you can't do it on the ASX, but things like activewear. You know, you go back 10 years ago and there was no Lululemons, there's no Under Armours and companies like that. So, you know, sportswear was just pretty bum basic stuff. You know, even Nike stuff was nice, but it wasn't like super high end or got these fashionable edges around, you know, more marketing edges to them. So you can go find trends like
another
that.
One of those was like the sneaker theme. Like there was, I don't know, maybe 10, 12 years ago, like all these like really cool looking kids lining up overnight to get like the latest Adidas drop or something. Yeah. And you could have piled into Adidas way before the market figured that out. And that's just a consumer theme that you just walk through a mall or whatever and you just see that. happening before the markets figured it out.
Does that, do you think Lavisa falls into that category? Like, or at least it did a while back?
Yeah, for sure. Like you walk past a Lavisa and it's fucking chockers. Like, obviously not at the moment, but on a normal like day, you walk past any one of those shops and there's always like 30, 40 people in there. Like the past 2 years, you've had stuff coming out your ears in terms of ideas for like pre-COVID or like reopening, like travel, like video calls, all that sort of stuff. Like there's been so many and so much volatility the past 12 months.
Yeah, so, like in other ways outside of themes, just people I've met through the years, social media, Facebook groups before FinTwit, managed to meet reasonable people off Hot Copper, believe it or not.
Yeah.
And then you just find people where, yeah, they do. They do. It's how I met my expert in mineral sands. And you just chat to these people because these people for most of them, it's a hobby. Now, I don't know a lot of people in funds management that well and don't deal with them or go to events and things like that. So I'm not sort of in those circuits. So outside of IR brokers, it's just the personal network of people I know who really great private investors, have very different experiences. They look for different things and they'll always just shoot an idea through. So a lot of that can just be bespoke stock picking, not necessarily relating to a theme or something that's going on in the markets from a macro perspective.
Yeah, and I suppose you just got to kind of be aware of the fact that like anything can provide inspiration in life. Like, you might, like Geordie, you might be walking past a Lavisa with your misso. She's talking about Lavisa, and all of a sudden you're like, wait a minute, Lavisa. Or you might be talking to, someone you met, and you're just like, oh, okay, that sounds like a great idea. You go do the research.
A lot of people had Afterpay. Like, you could see Afterpay in the shop windows everywhere in Australia before it was even like the right stock code.
Yeah, right.
Yeah.
But what's the difference though between, because obviously, and this is what I guess the whole theme of this is, from concept to implementation. So you got a concept, right? You pick up on something, you see some inspiration, you have a conversation, you get a little tip. Like most people in life, I think for the most part, we kind of, I think most people who kind of aren't, professional stock pickers or fund managers, et cetera, at least successful ones, most people kind of, they might see that, they might go, oh, nah, that's not going to work, or kind of like dust it off or blow it aside, or maybe they kind of like pile in too late because they get a bit of FOMO after they kind of let it go earlier. How do you go, maybe Geordie, I'll start with you here, but how do you go from like, that sounds like a good idea to, all right, how do I make this work?
Yeah, I'll give you an example. So I'll go for a theme: autos and electric cars. Like, that's a pretty easy one.
Yeah.
So Tesla, every value investor has wanted to short Tesla for like the past, I don't know, 3-4 years, right? It's been a terrible widowmaker trade to try and short that company most of the time. Now, after a bit of gatekeeping, it looks pretty decent for a short at this point. But if you're trying to hedge out some market risk and you want to find an auto company on the other side to go long, because for the past 12 months, autos have just been insane. Like, people have been buying cars everywhere to not use public transport. They don't want to catch the virus, blah, blah, blah.
Yep.
So I go, all right, I'm thinking about a Tesla short. I want to find something to put on the other side that will work as a long. So I just go and dig through car companies, BMW, Mercedes, VW, et cetera, et cetera. I found Porsche. So Porsche is, it's a family company, and it's actually owned by VW, and the company for Porsche is basically just a holding company for VW stock at this point. There's some sort of weird arbitrage in there that the valuation is actually less for the VW stock that they hold, but Porsche make like the most shit hot electric vehicle that you can buy. Like Taycan is the best out there that I know of, and they also make pretty amazing other cars, but it's just the VW holding company really. And Volkswagen are also bringing out their new range of electric cars, and they have better manufacturing, decades of experience in making these stuff, and they make cars that people in Europe, Australia, everywhere want to buy, right? And so Tesla had dominated the electric car market for years because they were first.
Yep.
And now VW is coming out with all these shit-hot electric cars trading on a fraction of the multiple. And then I could get Porsche, which was holding VW stock at a even cheaper rate. So my way of structuring that trade moving into 2021 was being long Porsche and short Tesla. And that's how, like, obviously I'd beta adjust it. And I generally, for trades like that where it's not like a like for like, I'll actually put it in a little spreadsheet and watch if it's working first before I put it on.
Why isn't it a like for like? What do you mean by that?
Well, Tesla holders are like,
it's a tech company.
Their heads in the cloud. Yeah, it's a tech company. It's not like.
It's not a. Yeah, okay. Yeah,
and my favorite shorts are tech companies in inverted commas that are actually just making something that's like really, really low margin or in a shit industry. Like cars is a shit industry, really. Like it's the worst and hardest industry to be in. Another one was iRobot. So that was one of my shorts.
There's a company called iRobot.
Yeah. So they make the little Roomba vacuum cleaners. You know, those little like robot vacuums that's like automatically just go around your house and suck up whatever.
They're kind of dope though, right?
Yeah, it's a cool product, but the market was valuing like it's a tech company, but it's an appliance company. It makes vacuum cleaners. Like,
yeah, okay.
It's the best thing I ever bought, one of those robot vacuum cleaners. I got one that mops as well, which is great for grubby little dog paws. Traps mud in.
Do they actually do the thing? Do they actually, like, they fucking get around and do their job?
Yeah, for the most part. As long as you don't have, like, certain furniture that it can't get through, there's always a few little things you work out the first couple of runs, but they're pretty bloody handy.
That's wild. I need to get one of them to maybe day trade for me at the moment.
Why? Is that because they suck? Sorry, that's good.
I'm just gonna remove that guy from being a speaker.
Sorry,
How is it?
You give me that layoff, I can't not take it.
You got to take it. All right, there you go. You happy? You've said your two bob worth. You can go back to.
That's my colour.
You can go back to mute. Beautiful. George, you said beta adjust, right? What does that mean? I got no idea what that is.
So, like, there are certain stocks that move further and harder than others each day. So if you're doing long short and you're trying to hedge out your risk, you need to adjust your position size if one moves less than the other, if you know what I mean. Like, if I buy like a big bank, it's going to be relatively low beta compared to me buying some little small cap stock that might move 10% on any given day. So you need to adjust your position size for the one that moves further. You've just got to, if you know what I mean, like if you.
So give me an example in terms of sizing, like, and that. So Tesla, what is that trading? What was that trading at when you put it on?
I think it was around $800 when I started the short.
Compared to Porsche was
Porsche was, where are we? I think it was like, 50 euros or something like that.
Okay.
And it got
So
up
you're
to like 85, 90.
Right. And so when you put it on, are you doing like, say, are you doing like 10 times the amount of, or 10 times the amount of shares? As in, like, would you be doing like 100 on Porsche?
It's just like, if one of them's moving 1% in a day on average and one of them's moving 2% in a day, then I need to adjust my position size down for the one that's moving further. That's all.
Okay. Yeah. That makes sense. All right.
But I'm not one of those people that will go, I'm going to express my view on banks and I'm going to go long one Aussie bank and short one other one. That's just the dullest way to do long short, in my opinion. And it's not really like, for someone of my size, it's just not going to be, it's not going to make a lot of sense.
Okay.
I've got a question on that. So how do you manage your risk outside of just the beta risk in absolute terms? Because obviously the Porsche VWs, the big value trade, Tesla's the sexy growth trade. How do you manage that potential widening gap before it comes good eventually? Because, you long one, short that one, you get blown out the water just standing pat.
Yeah, so I'd gatekeep it first. So I won't put it on unless it's working initially. And generally I'll do a macro overlay as well. So depending on the way bonds are going is whether you'd want to be long value or long growth. So 2021 had a fairly full-on 4 or 5 month period where those hyper growth stocks sort of fell out of favor compared to the low multiple value stocks. So I wouldn't even be considering a trade like that unless I had the macro supporting me, I guess. But in terms of like risk management, I would stop out at predetermined areas, and I'd probably have that on my spreadsheet before I started.
This might sound really dumb, but I'm going to go for it anyway. If you're doing long short at the same time, how does that doesn't that like minimize your potential return? Or are you just expecting both of them to work at the same time? Or are you expecting like,
it's amazing if they both work.
Yeah, but it's like one. It's
but
like
that's not the case a lot of the time.
Yeah, because why wouldn't one just cancel out the other? I mean, I know that's a very basic way to look at it, but
well, you're taking a view on one that's ridiculously overvalued, and one that's actually quite attractively priced and has a real theme, like a real catalyst behind it.
Yeah.
So VW is just about to release electric vehicles. So
you're hoping that Tesla mean reverts into being a car company, not a tech company, and then car companies car companies would go up, and then Tesla comes down or back to earth on like a car maker multiple. Is that sort of where you're going with it?
Basically. So you basically have a look at every other EV manufacturer and what multiple it trades on. And then you have a look at VW and what it trades on, which is like a 5 or 6 PE at the time. And then you look at Porsche, which is even cheaper VW stock. And you go, this looks decent as a long on the other side of a Tesla short.
Yep. Okay, gotcha.
Yep. Yeah. No, it does make sense. So it's got to be. Is it always in the same sector?
It's just generally my view on a theme, really. Like,
yeah, right.
For COVID, for example, like I traded COVID terribly. Like, in terms of when that happened, my only idea was companies that make ventilators. So that was ResMed and Fisher Paykel Healthcare. But I didn't have, I got absolutely smoked on one particular trade that was intrasector, and they were a debt collector. So I had Credit Corp as my long, which is like a pretty amazing company. And I had Collection House as a short. And Collection House actually went into halt for a long, long time.
Oh, I remember
and
that.
we're in halt during COVID. And this company is basically a failure. I did a lot of sort of background work on this, and they were in a lot of trouble. And there's
Did I just drop out or did Geordie drop out? Nick,
No,
can you hear me?
I can hear you. I think Collection House longs may have got to it.
Yeah, G, you just dropped out for a second.
Some PTSD there, staring into the distance.
Yeah, we got you. Yeah, you just said Collection House went into halt. And they were failing as a company. That's the last thing we heard.
And Credit Corp just got absolutely destroyed in March 2020. So my long, which was the good quality company, just got smashed. And my only solution was just to buy more Credit Corp lower and hope that Collection House eventually came out of halt. But that's the risk you take, I guess.
Yeah. I mean, it all comes with a risk, right? It all comes with a risk.
But like themes for intraday, I had like for this week, I had those retail, like as I was saying with like Lavisa and stuff. I had China Credit Impulse Iron Ore, which was fucking massive. Like iron ore stocks just got smashed. I had lithium as well, and I had lockdowns and banks. But I don't know. What do you guys think in terms of? Do you think it's useful for intraday to have like 4 themes if you can't think of anything to trade?
I mean, it probably would have helped me this week to kind of focus on some themes, but I personally am not really thinking about them too often.
It's just purely price.
Yeah, it's purely price, purely order book. Like that's it. I mean, it's obviously I take some of that stuff into account, but it's I'm not really thinking about the theme. I'm just thinking about where's the volatility, and that kind of comes off the back of a theme. But I don't know. I don't think of that first.
So I think like for me anyway, I will always have like a theme in the back of my mind. So for example, when I turn the computer on at 7 a.m. and there's no news,
9:55.
Yeah. Oh, you got me. But yeah, in my mind, before I read any like news on the day, like I'm always going to have like a theme in mind, like in my back pocket. So for the last 2 days, it's been watching iron ore names like BHP, FEX, Fortescue, Rio, etc. So there's that like overarching theme behind it. But then as I start to sift through the news, I'll be like, okay, is there something that's going to be more, or something more urgent that requires my attention? If not, then I'll resort back to trading those themes, if that makes sense.
Yeah, I think that's probably a good way to look at it, because they're generally not going to be that straightforward.
You go, Sam.
No. I was just agreeing with Nicholas there.
Yeah. So, and I guess like last week it was lithium. Like there was this underlying theme that you could go back to if some new idea wasn't working. Or wasn't.
And I guess like you've had earnings like the past week and a bit where there's like been heaps of shit to do. But I've found for intradays, especially when there's like nothing on, to have like 3 or 4 things that sort of you can lean on for something that's happening in the market.
Good. I like that.
I guess
I like that. Yeah, I like that.
Yeah, no, I agree with that.
I mean, I'm not thinking of. I don't think I think about it as. I don't. It's not as obvious to me as like actually writing down 3 or 4 themes. Like I'll have a sense of what's going on, but I think writing it down or like really picking out those 3 or 4 themes and really focusing on them, or at least getting an idea of kind of what's going to be in play within those themes, is a pretty good idea. I think that's pretty smart.
Like I get super nerdy on it. Like Josh, I don't know if do you ever read the ISM, Josh?
I'll keep track of those general macro, but I'm not necessarily trading or positioning over any short time frames for, minute changes month to month. But, there is that old saying, the trend is your friend. And at some point, if it keeps going against it, you got to have a really hard, long think about what you own and the catalyst and value creation that you expect from those stocks going to be more powerful than that. Like when it comes to iron ore, I've got nothing other than a small position in TLM, which I wrote about a couple of months ago, but that's just because the royalty's got low value and it was so cheap to begin with, and it's got other drivers in the business that can add value independent of iron ore.
So there's this report that comes out called the ISM PMI, and like everyone here would probably know it, and it's basically just
what is it?
Well, the PMI is like it's a bunch of purchasing managers for different sectors, like different companies and different sectors, and they do a survey on them about how well shit's going, basically. And the sum of the numbers turns out to be either above 50 or below 50, and how far it is above or below on the index is how positive things or negative things are. So if it's above 50, things are positive and the economy's moving really well. If it's below 50, then it's starting to get a bit dodgy out there. And most people just look at the PMI in the manufacturing or services. So there's 2 of them. So services businesses and manufacturing businesses. Most just look at the number and go, all right, sweet, it's 55. Like things are going okay. But they actually release a report about what each person in each sector says. Like they give a little comment. And it might be like, for example, it might be comment. A cheeky little like hint about what that purchasing manager is going through at the moment.
Yeah.
So it might be like apparel, for example, or like shoes or apparel. That purchasing manager might be like, fuck, I'm super busy. Like I can't get enough stock in. It's like shipping's really hard, blah, blah, blah. So that in itself is enough for me to go, all right, what are some apparel companies I can look at and start a trade on? Because this person has told me like that shit's really busy, and generally they're ahead of the market by 3 to 6 months. So you can get in before stuff happens, I guess.
Okay, I like that. All right, I just looked that up. So it's the ISM
PMI.
PMI.
So there's one for services and one for manufacturing.
Oh yeah, I see them here. Yep. Okay. And how often does that come out?
They come out heaps, and there's one for the US, which is the ISM, which is the main one. But they have Euro area ones and the Chinese one, which is probably just lying to all of us.
Yep.
But yeah.
Beauty. All right, I like that. Hey, I'm gonna cross over to you for a second because you said something a second ago that I found interesting and I wanted to kind of like touch on a bit. You're talking about if the kind of broader trend or the macro theme kind of is telling you, hey, maybe this individual stock pick that you have is not really working out. At what point do you kind of like take heed of that? And is there like some stops or some measures that you have in place to kind of think about differentiating from those two things, the macro thing versus like the strength of a company?
Yeah, it's always a hard one.
Does that make sense?
Yeah, it does, because sometimes you'll have your conviction in a stock and then you end up being a baggie by the time those catalysts get realised.
Yeah.
But in terms of that, like one thing you can do is you do have stops. For me, they're soft stops, so they're just more mental checkpoints. Like, is there something changing? Is it going, is there a reason why? So, with a lot of the macro stuff, particularly when you look at cyclical sectors like commodities, you get a lot of flow coming in and out of the stocks. So pretty much since the bottom of COVID, we've just had accelerated flow into commodities, and now you've probably got the reverse going in. Now that there's the Delta blues in China, growth fears, probably predominantly because of China. You got other places in the world that, despite vaccinating their populations, they want to do lockdowns. Obviously, that's not great for growth that's going on. And, a lot of that long-dated stimulus for EVs and that drives the inflation and cyclical story is pretty long-dated as well. So for me, there's just those mental checkpoints to stop. If it's come off 20, 30% from the recent high, the first check is, do I buy more if it's all intact and everything's going away? Because a lot of micro caps and small caps, they can retrace by 50% and the story's still intact. They just can be quite wild and volatile over time, just based on sentiment flows. If it gets caught up in a theme where the punters really run with it. And I swear to God, the punters are more powerful than they've ever been in the 10 years I've ever witnessed markets as well. So maybe that helps exacerbate it. Previously, before Capital H, when I was running my PA, I kept the top stop losses a lot.
What's PA?
Personal account. So I was living off my own capital for about 2 years, from the hedge fund through to joining Capital H formally. I ran stop losses probably a little tighter, a little bit more formally than I would do and can do at Capital H, because there is just a different way of doing things that I've blended into. Because sometimes if it's going against you, your timing might be wrong. So why would you want to walk it down 50% before you look right? And I used to do that so much in the early days, just looking good. A stock's up 50, 70%, goalposts keep getting shift, you get sucked in, death by 1,000 cuts. Next thing you know, you're down 50, 60, 70% in a position. So for me, it's just a case of these mental notes. It's not working. Why is it not working? Go find it out. Does the thesis change? Does it dampen your enthusiasm? So I take some profits or reduce risk if you're underwater. And then just at some point you got to go, I must have this wrong and I don't know why. And if you don't know, get the fuck out. Simple as that.
That's a good point.
Being too early is a massive, massive risk as well. Like what Josh was saying, Josh Evans as well, when he said he had a massive short on Qantas. He was right. He was 100% right, but he just was a little bit too early. And it happens every day. Like one of the guys calls out iron ore or something, and iron ore's off 5%, and you're like, fuck yeah, it's time to pile in short.
Yeah.
Fortescue short in the afternoon type thing. And you just it just stops you out and then dumps. As a trader, if you're too switched on, you can get fucked sometimes because you're too early.
Yeah. Can I just say something completely off the beaten track right now? But how good? Only because I've heard this said a couple of times today already. How good is it to say the word Fortescue? Just the way that it kind of rolls out of your mouth, like Fortescue. Does anyone else get that?
I prefer Phoenix. That's a lot sexier.
Phoenix. Yeah.
Sexy.
Okay.
And it makes it easier for a lot of borrowed conviction. Guys.
Fortescue's my biggest loss ever, so that's not sexy.
I tried shorting that once too. It's a widowmaker, shorting Fortescue.
It's not sexy, yeah. Okay. So Fortescue, not sexy, is on the not sexy list. Is that what I'm hearing?
Yeah.
Sexy Fex, mate. It just rhymes.
Sexy Fex.
Male is
Rhymes.
Male is the Manly Seagulls is a pretty sexy name,
Yeah,
which I'm currently watching.
pretty sexy name. Shitty team
Hey,
is what I'm. Is my
I don't know
mail.
about that.
Coal stocks. Is coal stocks sexy?
Coal socks. No. All right, back on track. So yeah, sorry boys, I took us down a dark path then. So yeah, JB, just to kind of like keep going down that, keep pulling on that thread a little bit. Once something's, retraced, you've had that kind of thought process. Am I adding here? Is the theme still intact, or is my idea still intact? I guess I guess I'm interested to know if you have an example where, what thing was you had thesis, trades working, it's retraced a bunch, and now you're kind of like, all right, what do I do? Do I go with this, or do I load up more, or do you have an example of something like that you can talk about?
I've got a good one, and it's called Zuno. I'm not sure if anyone knows about that fantastic, innovative hand sanitizer company.
Yeah. They're a tech company,
winner.
right?
Something like that.
Big COVID win.
Like late 19, I think the stock was sort of turning around, all these contracts, minimum supply agreements. A lot of them turned out, they're hot air and probably glorified toilet paper like MOUs for graphite supply to unknown Chinese companies back in 2012 type. But, some of them actually had reputable names to it. And then you had a few in the ag sector. And at the time, pre-COVID, a lot of people forget that China had a massive swine flu epidemic as well. So this particular molecule formulation they had, you could have various different products from a regular hand sanitizer through to this white version of it you put in feed, and it helps reduce viral risk, contamination and spread in pig farms. So you bought a few of those. You do all the checks, management, dodgy history, red flags, all of that. But at the same time, it probably wasn't the sort of red flags where you think it'd get into suspension one day and never come back. But then it had a really strong narrative. You had a tailwind in the share price because post the RTO, it did a year or two before, the stocks were flushed out, rebased, getting a bid, responding positively to news. So they're all those sort of little trading technical tailwinds you want behind in your sales as well. And then they're signing these deals, big numbers, the revenue starts kicking in. So I was buying that stock at like 17, 18 cents. That thing just flew into New Year's up to like $1. And then when you got into January, it starts rolling over, and you just knew it was a small trade. Don't believe the bullshit. A lot of times people will take these moderate positions, they go super well, and they convince themselves they're long-term investors. So conversely, people who bag you out and walk a stock down 50, 60, 70% do the same. But a lot of people do the same on the upside as well. So for me, it corrected really hard, breaking 10-day, 20-day MAs, 50, and then I started hosing out stock. And this was all through January. And then you get to this point in February, March, where you got the COVID outbreak, lockdowns.
Yeah.
The news reports of hand sanitizer getting cleaned out in China, and then Taiwan and Korea. And I wasn't actually 100% on the ball in this, but the guy I know in one of my investor groups said, fuck, don't you think people are just going to buy this shit? Because it's 24-hour protection for hand sanitizer, one use, 30 days for the spray and cleaning versions of it. And I thought, fuck, yeah, you're right. And then you just actually jump back in and buy the stock. So not only was it was aggressively falling and, hype narrative-driven sentiment in the first run, and then you get like a fundamental thing that could drive real sales, which it did for a while. So ended up, I think my average out was maybe 50 cent range. I was buying the stock back in the 70 cent range and rode it through north to $2. So it's a story of a stock where you sort of run it up, cut it loose, because it's a trade. Don't convince yourself otherwise. But then when something did click, that narrative can re-engage, and there was some fundamental support to it because they were generating sales, and then you trade it again on the long side. The best part about that story was my mum works at a cleaning company. So I told her about it. And they're a specialised cleaning company. So they do a lot of COVID cleans in Queensland at the moment, but they were doing, mold remediation, crime scene as well. Someone shoots their brains out and you go scrub brains off the ceiling type work.
Damn.
People that do that stuff. And they looked at it,
That's
all the stuff behind
NDAs. Portfolio,
NDAs.
I reckon.
That's what's the center stock if it was listed, yeah. Well, it's actually an ESG stock, right? Makes the house livable again, clean meth cleaning, stuff like that. It's ESG stock, probably gone a million times revenue if it listed. So,
yep.
So my mum bought some, same time 90 cents, wrote it up, wrote it down, wrote it through, sold them mostly over $2. And then and that was all pretty much done and dusted just before her birthday. And she goes, what are you getting me for my birthday? And I said, I gave you 6-figure gains in Zuno. And she goes, no, that's just paying me back for the raise here. What do you get me for my birthday?
Damn.
Nice little side note to that. But that was one where you got to, there's a mentoring bias called anchoring as well that people succumb to.
Say that again.
A mental bias called anchoring. So I bought them at 19 cents. You write them to $1. I hose them out in the 50s. But then you have to...
What do you mean? Like $1.50?
No, 50 cents. So at one point I was up 5 times my money and I sold them pretty much for 2.5 times my money up. But it was a small trade.
Right. Yeah.
But the anchoring bias, a lot of people go is, I was in this thing, I walked it down a bunch, made less money than I could have, sold at this stock. But if the idea works again and it's a higher price, people will be like, oh, I don't want to pay a higher price than what I sold them for. So you get anchored to a historical price for whatever reason. It's the same mentality people have is if this dog shit cunt to the company that I'm down 80% on gets back to even, I'll flog it off. It's the same sort of anchoring bias as well that you have to overcome.
That happened to me really badly with Vulcan.
That was the first stock you ever talked to me about. You're like, yeah, you want to buy some of these? And I'm like, oh, I don't know about that. That's
mate.
Geothermal.
I was telling you about the fucking options.
I know, at 40 cents.
The options at 90 cents. Yeah.
The options were 40 or something. It's like, yeah, I don't know about this geothermal project with some lithium brine on the side.
Yeah. Anyway, so I think I got them out at $3 or $4, and then in the next 4 days watched them go to $14, which was fun. But that's the
wait. Was it actually fun? Just to be clear.
No. I hate that stock now. That was the worst fucking trade, and it's one that was really, really good. But it's it was purely theme. That company is the greatest marketing for any commodity company I've ever seen.
Engineered for European ESG. That's all it is, in my view.
And all of the carbon neutral, Tesla, ex-Tesla people, ex-VW people. What did they just signed up Nico Rosberg or whatever? Just an absolute marketing masterclass. And that was the best theme trade, and I completely fucked it.
Is signing Nico Rosberg up the European equivalent of getting Andy Gilchrist to sell sandalwood?
Pretty much. Probably is.
Hey, G, just to be clear though, I remember you did pretty well on that trade. Right, and it did kind of.
Yeah, my average was under $1,
and it did keep kind of vert when you got rid of them. So, or did it? I can't remember exactly, but I remember going, oh fuck, that's such a good trade. But then obviously
I had 12,500 of those options.
Yeah,
and I got out around $4, and then the next 5 days it went in a straight line to 14.
Yeah, it did. And look, that's that is tough. That is tough. Yeah. No, I hear you. Oh God, I'm looking at the daily chart now. That fucking right. That's wild, eh?
But the reason, when you guys probably made more money from it than I did, because you didn't have that bias where I was so pissed off about what had happened.
Yeah, you're not going to buy
I just ignored it.
Yeah, you're not going to buy them over what you sold them for, right?
you and Nick are like buying them every day, watching it go up to like 10 and then 12 and then 14 or whatever.
Yeah.
And I'm just sitting there like a sook, not doing anything.
Yeah. Well, how do you combat that? How do you combat that?
So you learn not to anchor, right?
I could.
Yeah, what?
It's hard.
Yeah, because I mean, to be fair, they're very different things. Your long-term trade in Vulcan versus like you trying to day trade it, they're very different things. How do you separate your brain in that circumstance?
But it's like you everyone who's day traded has experienced this. Like something's down 6%, you're like, this is down too far. You enter, you buy a little bunch. Then it's down 7, you're down a couple of $100. You're like, you buy another bunch. Then it's down 8.5. You're like, this can't go down any further. You buy another bunch. And you've completely lost your mind by this point. Like your mouth's dry. You've been sitting at the computer for like an hour and a half, watching the tape of this thing, just begging it for it to go up. But you've completely lost all objectivity. And I think once you get to that point, you just need to cut your losses and step away. And especially if you've had like a winner that could have been 3 times larger, you need to objectively look at it and go, okay, I got this for this price and I got it out for this price. That's an amazing win. On to the next type thing.
Yeah.
I think something like that, like it's sort of a similar experience I've had with a few of the big longs that I've had, like Caravelle and Jindalee, and it's the anchoring process there as well, similar to Geordie's experience with Vulcan. Is, you know, when I was buying Jindalee, the thing was already up like 5 times in the prior 6 months, and when I bought it, I've gone on to make good money at scale. So sometimes, at least with the fundamental side of what I do, you can look at it and go, yeah, this thing's up 5 times in the last 6 months, but it's barely $100 million market cap, and it's a project that could be worth $2 or $3 billion. It's still cheap. What are the catalysts? It can keep going if this certain theme keeps playing out. So far, it's been working. You know, similar to Caravelle and other stocks that I've bought. You know, you sort of got to go, it's gone up a lot, but based on what the price of it is today, its value, what do you think's priced in? What can it be worth if it meets these expectations? Can I still make good money, and is it better than anything else I can find? And you just got to run with it as well. So I guess a mindset like that with Vulcan, if you could get over the gimmickiness of it, the technical risks, and grab the bull by the horns, and that was probably one way you could run something like that a lot harder, or come in a bit later and still make good money out of it as well.
Yeah. Did you trade that, Josh?
Oh God, no! I'm too cynical for stuff like that.
leave it to the plebs like Geordie.
So when I was doing like my placement at Wilson HTM, like that was back when you had coal seam gas all the rage during the late 2000s. You had people trying to do underground coal gasification, which, funnily enough, LCK is trying to reinvent that same process by calling it a different name and doing zero carbon fertilizer. But at that same time, geothermal was still pretty popular, and it fizzled out because it's just a fucking disaster. Like, find places that are doing mass scale geothermal energy outside of maybe Iceland, and it doesn't work. And something with Vulcan, when they put the feasibility numbers out, I think a lot of the MPV is literally just a power arbitrage on German regulated power arbitrage. So you can pull it off the grid at something like 12 or 16 cents, and you flog back green clean energy at 24. And then hopefully you get the lithium working with DLE. And, you know, I've got a position in Jindalee still. It's clays, it's unproven. So, you know, can't throw too much mud, but DLE is also unproven at a commercial scale. That's still a technical risk for them. And if they can prove geothermal at that scale and DLE, it'll work. It'll make a shit ton of money probably.
What's DLE?
Oh, direct lithium extraction. So normally with brine, because what they have is you pull the fluids out, and it's the brine fluid that they're pulling out. So the heat from deep in the crust powers generators, steam generators, generates electricity, sells the grid. And then with that fluid, they'll strip out the lithium before they re-inject it. And then what they're proposing is like a DLE process where it's like an ion exchange type technology or something like that. and it sort of converts it. So normally with a brine, you'll have to go put it out in a pond and let the sun evaporate it for a while before it crystallizes enough and concentrates for you to scrape it and then run it through the processing plant. So the brine stuff is what they do out in Chile and Argentina, up in the Atacama.
Do you think,
and
Josh,
what's
this is probably a
DLE?
good question for you. Do you think that value investing has that same bias? Like this isn't working, I'm right.
Geordie.
So it's not me. Geordie's in and out.
No. Geordie, come back to us, brother. Don't go towards the light.
It's got PTSD.
Don't go towards the light.
Vulcan PTSD now, talking about it too much.
Yeah, no. Yeah, say it again, G. You dropped out there.
Oh, okay. Do you think value investors have that same anchoring bias? Like since 2018, when rates have been cut to zero, do you think they are ignorant of how trading and investing should work now?
I don't know. There's a lot of people in value who've probably evolved, and I think there's a lot of people who practice value. This is sort of going back to my Zenith days when I was doing funds trading and looking at people under that lens, growth versus value and all those sort of subcategories that the consultants use. A lot of guys are just screening for cheap shit, and you can buy a bunch of indebted, really crappy businesses that might not necessarily have good prospects to turn. And I like to think what I do, I'm in a lot of stuff that looks quite growthy, but there's always some sort of value and catalyst to realize value. So, and this is similar to Harley and why, I was good fit for Capital H is the way we look at stocks. Value in a relative sense rather than an absolute sense, and trying to avoid value trap type companies as well. Just because something's cheap doesn't mean it's going to be a good investment or you can make money. And you want catalysts as to why it's going to be better. So Lark was a good example of a turnaround value play that had catalysts to turn around and re-rate. And that's been way better investment than I thought it was this quickly. That's for sure as well. So a lot of luck. It's involved in there as well because, the luck might be I could do the work, get it right. It goes from $1 to $2 or $3. And then that luck that they punch the lights out in the turnaround, they get the whole institutional investment community behind them wanting a piece of the action. And that's what takes a stock like that to $5. This early in the piece as well.
Do you, what I was more referring to, like I own coal companies and a couple of tobacco stocks and stuff. It's almost like the market values cash as a liability. Like in terms of companies that just spit out cash but aren't necessarily growing, there's no impulse to buy them in the past 2 years.
Unless you can show what you can do
with that?
Yeah. Oh, with coal and stuff there, you've got this whole ESG trend that just makes it even worse. There's probably a bunch of people there who would be like...
Coal and tobacco.
Tobacco as well. Over long periods, tobacco ended up being a good investment despite decades of litigation, penalties, taxation. Coal can probably be the same, but you're probably still at that phase where you got all this money trying to exit those names before you gets in the hands of people who don't care and will pay a valuation because they're not beholden to those same principles and trying to protect fee margins. The amount of people who backflip and go, we're all ESG now. I'm not going to discount my fee. You can still pay the same rate because I'm giving you this ESG shit. There's a lot of people who do that. And that means coal goes and things like that. But at some point, they'll get priced better if the coal price stays high, supply is constrained because of those factors. There's just a big transition period in those names, I would suspect. And that could be, the amount of capital that's got to come out and then find people who will bid it and hold it, who aren't beholden to those same principles. That could be, take years to truly reflect as well.
It's like Vulcan, for example, like that is marketed as a company for the future. will probably not generate any cash for years, if it ever does.
Yeah, but doesn't mean you can't make money on it. But it's probably not so much that the market doesn't value the cash per se.
But the market will moon that theme 200 times over compared to a coal company at 1 times earnings, for example. Like, the market doesn't really care about cash generation when bonds are like 1.2 on the 10-year and inflation's at 3%. Like, they genuinely think that cash is a negative yielding liability at this point. Like, they'd much prefer to buy the growing thing or the future thing than something that actually makes money.
Yeah, there's a lot of companies that can grow and make money and generate cash, and if they reinvest it, they get rewarded just the same. I think stuff like coal, it's regulatory headwinds and tailwinds. You know, some really great investments are in companies that benefit from regulatory tailwinds because the government says, "Oh, you cunts out of there, got to go buy this stuff, this product, this commodity, this electric vehicle." So electric vehicle means you buy lithium. Everyone's like, well, they're just going to regulate it into existence on a mass scale. So let's go buy all this stuff because it's just going to be a mismatch in supply and demand, etc. On the other hand, the government's always going to penalise and regulate against coal. So those cash flows they generate are just considered riskier cash flows versus a company that could generate strong cash flows. A lot of them, you know, those sort of trends, coal, new energy versus old energy, it's shit ton of cash flow generation in old energy. It's penalised versus all these companies that don't generate cash. But a lot of them can go on and generate strong cash as mining companies in time. But I think it's more about the trends in regulation that drive those massive valuation discounts and structural, which can probably be structural for some time to some degree around the cyclical nature of those commodities. But, you know, a lot of companies I invest in can generate cash flows or generate cash flows, generate growing profits. And if they can reinvest them and compound that, the market rewards them if they do it. So, but, you know, a lot of concept stocks, fantasy stocks, ultra high TAM stocks, there's that whole cohort of growth that gets exacerbated, and zero rates, you know, definitely amplifies that. So I'd agree with you that it is an influence, but probably not the defining factor in isolation. You know, VC shows you what zero rates do. There's no hurdle for money. People will fund absolute fucking garbage, and every round's an up round, no matter what.
And like people buying fucking penguin JPEGs for $100,000. I mean, stocks look pretty fucking good compared to penguin JPEGs.
What's a penguin JPEG?
Oh, mate, NFTs, get on it. Not advice.
Oh. Okay.
I won't lie, those penguin JPEGs, they're pretty cool. But am I going to go and spend gazillions of Bitcoin or Ethereum on one? No.
Someone's going to have to link me. I've got to see these penguin JPEGs at some point. Yeah, thank you. JB, I just wanted to know a little bit more about your time kind of, you know, in the running your own account and all the freedom that came with that, how you're able to stay kind of structured with that time, and then I guess lead into like why go to Capital H?
Oh, well, why did I need to do it and how it's structured? Otherwise, I'd probably waste my time playing video games all day and watching the NBA whilst trying to find a job.
Doesn't sound too bad, though.
Yeah.
Like it sounds like you were having success in that time, right?
Yeah, no, it was pretty good outcome, all things considered.
Yeah.
I had to run my capital pretty hard because I had a pretty modest capital base and had to pay bills. Which is no different to the day trader stories or the trader stories that everyone else before. But I sort of took that time to reflect what's worked, what hasn't worked. If I've got to live off capital, how do I have to change it? Because if you don't have the luxury of getting an income, you can't sit there and buy and hold and give things time to play out. You have to really sweat your dollars in the market.
Make it work.
So, you know, just introducing, stop losses, be a bit more disciplined. If something goes against you 15, 20%, cut some loose and then reevaluate from there and manage risk on the downside better. That was something, because you had a wage and a job, and that downside risk was something I never structured very well for a long time because there was no, it wasn't as important. The pressure wasn't there to make it that important. Just even keeping a ton of portfolio stats like all you guys do with your day trading and stuff, strike rates, average wins, losses, all that sort of stuff. And
also, would you be like kind of keeping track of what sectors you kind of perform better in or something like that? Is that stuff relevant?
Not so much for me. Like, I can't do medtech and biotech to save my life. So there were definitely areas I didn't do very much of. And if they were, it'd probably be more technical driven. So when I was running that PA portfolio, I had like this core of high conviction, fundamentally driven stock ideas, basic trends, breakouts, breakdowns, things like that to sort of help around the edges. Then I'd just have a much more higher turnover, smaller end of the portfolio where, it'd be catalyst trades into an event, or there's just a technical breakout and I'll buy it.
A little bit more punting.
There'd be a lot less fundamental. The fundamental screen would be, am I going to get cucked by a fucking trading halt in a raise when this thing goes up 10% or something like that?
Right.
Otherwise, you just look at it, numbers are all right, I can see why it's going up, I'll just trade it, and then when it stops going up, I'll fuck it off. And you'll just clip 20, 30, 40% in a trade, and you do enough of those, a couple of those each month at that tail end of 20% portfolio, that pays your bills. And then you don't have to worry about your conviction stuff. You can let that sweat harder. More time in market,
that's a good point.
Take the vol on those ideas, which ultimately go on to be 2 baggers, 3 baggers, 5 baggers over time.
Yeah.
So I'm trying not to fund
out like your bill payers.
Yeah, your bill payers, but then your long-term wealth generators.
Okay.
So
I like that.
So at one point, like, the portfolio probably never really went over more than 25, 30% trading. I think I had these stats in that last note I'll put up on Twitter. But my annual turnover was over 100%, and it was generated by that tail 20, 25% of the portfolio. Like, I sweated that thing fucking hard, like a fat kid on a treadmill.
I think like the what he said about like self-analysis and reviewing how big certain losers are in terms of like your risk management and stuff. Like, Chris is like the master of like creating the Excel spreadsheet and stuff. And before I did that, in terms of like intraday, I was just sort of like a bit blind in terms of how, like, I kind of equate intraday like surfing almost. Like, some days you'll just paddle out, it'll be perfect, the waves will be great. 10 minutes in, you'll catch a perfect wave and you're fucking done for the day and you feel fantastic. But like four of the other 5 days, you're just getting waves smashing you again and again and again. You can't get out there. You're sort of like just trying to avoid drowning when you start, I guess. And it's like minimizing those losses is a massive key to staying in this long term and not blowing yourself up.
Yeah, people don't last because they blow themselves up before they can work out if they might be good. And a lot of people, and this was me when I first started, and that's why I have a reverse 10-bagger as my second ever stock, is because you get starry-eyed and you think of all the upside, and then you figure out what's the downside and how do you manage that. And then you end up walking down a stock. And a lot of stocks, it's not like one day news catalyst, it's down 50%. My thesis is wrong, I better go. It's like death by 1,000 cuts. And the next thing you know, you wake up, it's a year later, all the gold posts have been moved, the catalysts never come. But there's no big negative catalyst. It's all positive catalysts, just they always get shifted back another couple of months. And next thing you know, the thing's down 50, 60, 70% and you're fucked. And you just lost a lot of money. And, it's having mechanical processes, objective processes, stop losses, rules like that can save you a lot of bacon. Because the earlier you get out and you move on to the fresh idea, the better you are, you're going to start making money again. And when you get bogged down in something that's down 50, 60, 70%, it's probably going to be couple of percent of your portfolio, but it's going to take up like 50% of your mental energy and your time and focus. So not only are you wasting the time on this thing, that is probably not going to turn around, because especially in micro caps and small caps, most companies, just because they're listed, doesn't mean they've got any higher chances of being more successful than regular small businesses. They just get to last longer because there's enough idiots out there to keep getting capital from.
Yeah.
Right. So, these small business, the stats are like 60, 70, 80% of them fail within 5 years of starting. ASX microcaps or listed microcaps anywhere in the world are no different for the most part. They just get to last longer because there's a broker who can find some suckers, some cannon fodder for a raise.
Yeah, right.
So it's just rules to avoid getting stuck in those traps. And, one of the things I eventually learned as well is that you don't have to make your money back the same way you lost it, because the odds are it's not going to happen. So anyone who sits there going, if it gets to break even, I need to get out, you should just get out and fucking move on. Go find something new. It's got the trend.
There's massive opportunity cost with getting stuck as well. So if you've got that money stuck, you can't deploy it somewhere else.
Oh, exactly. And you're missing all these other opportunities you'll have more confidence in. They'll be easier from a mental standpoint. Making money in the markets aren't easy, especially over longer periods and doing it well. But, if you're getting bogged down worrying about this stock and it's going to keep going down, imagine all those things that are going up and the market likes the catalyst and they're outperforming and you can be on there, and how much more mentally, efficient is that for you? You're just going to sit there worrying, stressing all the time. And when you start having that discipline on the downside, and a lot of times maybe you're early and you go, I don't know why it's not working. I'll cut it loose. I'll downscale my position. And then if it starts working and it turns out you're early, scale that motherfucker back up and run it and be right on that same stock. But don't walk it down in full size, 50, 60, 70, 80%, to find out you're probably going to be wrong anyway, on the off chance that it might be the one that wins and goes on and you just got super early in a stock. That's like the example of Zuno I gave, that could have got a lot worse. If COVID never happened, that thing would have been smashed. But I got out, I made some good money. Then there was this new catalyst that came along and I thought I could make money again. I've actually had good success buying a lot of the stuff I lost money on like 8 years ago. So sometimes dogs get a second leash on life.
They get to go again.
Yeah, you do. And then that's just that knowledge you have from looking at lots of stocks over time. It's just time in the game. Not so much time in the market. You're going to win. Like, not that time in the market sort of thing, buy and hold and eventually you'll be right and do well. It's more like I look at so many stocks all the time, whether it's been in professional capacity or hobby capacity. But you eventually just learn lots of tickers, lots of names, people in the market. Because a lot of people shift, and if they're dodgy, to stay away. You learn about certain business models, cyclical versus non-cyclical, and you just build up a wealth of knowledge that makes you just a lot leaner, sharper. You can make faster decisions on a lot of things as well, and that just takes time. You always hear those stories of these fucking savants that just smash it out the park straight away, but for most people that's not how it happens, and it takes time. And I think by failing a lot and being quite shit and then pushing yourself for some self-reflection, and if you've got the passion, the genuine interest and passion to do this, which a lot of people don't, then hopefully that means you will ultimately be successful and you'll refine your process and the way you approach markets over time.
And I think honestly, the long road, the grind, is going to be a lot more rewarding, and you're just going to, I think, generally just going to feel better about it. I think the whole, you kind of like nail it out the park and then kind of never look back. Like if you don't have enough context, because if you don't get to experience those lows, you're never going to know how good the highs are. So yeah, staying in the game, and riding it out.
I think also like you to actually be able to put the work in to build a successful strategy, whether it's like any time frame really, you need to enjoy the environment that you're in and not get emotionally affected by it.
Yeah.
Because if you don't enjoy it and you're purely doing it for money, it's probably not going to get there.
Yeah.
You have to enjoy markets. Like, you have to enjoy getting up and doing it. Otherwise, it's going to be pretty hard for you to get through that initial period of being shit.
And like March last year, you got to enjoy waking up Monday morning, being limit down 10%. You know, if you don't like those days, you know, you won't last.
That's it.
And if you can't respond, you can't get through them.
You're not going to enjoy the 10 bags.
Exactly. To a degree.
Beauty. Hey lads, I think we're gonna probably dive into some questions now. We've been chewing along here for a little bit, and I think the people are keen to pick your brains, because I don't have any particularly great questions. I've just enjoyed the shit out of listening to both of you, but yeah, I think we might open it up to some questions now. How's that sound?
Sounds good.
Sounds good to me.
Sweet, let's do it. So, ladies and gents, if you want to jump on, request to be a speaker. In the meantime, I want to say thank you, JB. Thank you, G. I appreciate both of you coming on and giving what we're into like an hour and 45 minutes of your time so far. I'm going to be honest, 90% of what you both said went way over my head. But
Mate, you've hosted like a fucking professional.
Yeah, I know, but like it's good because I'm asking you questions that I'm like, wait, I got no idea what that means. I need to I genuinely want to know, and I'm hoping that kind of like unlocks some stuff for some of the people out there listening today. You guys know your shit back to front, and I do really enjoy listening to you talk about what you know and love. It's just that like some of it I just really don't understand, but I'm enjoying learning about it. So I appreciate both of you for coming on. I appreciate your time, sharing your knowledge. Yeah, hopefully you guys enjoyed it. Hopefully some of the listeners got something out of it. Yeah, so guys, jump in there, request to speak. While I'm waiting for people to request to speak, I am just going to quickly pump my own book, and it wouldn't be a little FinTwit chat without me pumping my own book. So here we go. I just put out a song yesterday. It's called Gratitude. It's a hip hop banger, ladies and gentlemen. If you jump onto my Twitter or anywhere that you listen to good music, Savilian, Gratitude. Look, I'm just going to say that it slaps, but you can find that out for yourself. So get on there, play it loud, play it proud, and show gratitude for, trading spaces. All right, we're going to jump into our first question.
I was going to say, Sav, it's from, just quickly, mate, Showdown was a good track. I like that one. Gave that to a few of my mates as well, and they all liked it as well.
Fuck yeah. Thank you, JB. I like that. I appreciate that. I love that. Thank you. All right, let's do it. Trader C. We're going to add you on as a speaker, G. Waiting to connect. Still waiting to connect. How's the internet on the Central Coast?
Is Chris
broken?
Wait up. Let's go again. All right, go for it, Chris.
And
we're
live. I reckon you booted me there, mate.
What's that?
You booted me there.
Well, you deserved it.
Fair. I was just wondering what your thoughts were on the new Tesla robot.
Me or Geordie?
Me.
Geordie and
No. Come on, like you know how stupid all this is.
The future's now. No, on a serious note, I was going to ask you guys. Your style's a bit different to some of us. So I was just wondering what you guys do to unwind when things aren't working for you.
I like that.
Tend to my garden.
Okay.
Pull some weeds.
Maybe something similar to what Fabs does. Maybe. No, I don't know. Probably just like research something that isn't the ASX, or go and look at something that isn't like if I'm getting spanked intraday, which does happen, yeah, I'll just go and I'll just cut it and do something else. Just go and research some other market somewhere. Because if you like, I've found that if you just get bogged down into watching tape after you've had a shit one, you just need to separate yourself from that screen for a while. Doesn't matter what you do. If you go exercise, read a book, have a wank, whatever. Like, I can just do something else other than
couple of Tom Hanks.
Look at the tape. There's times where I found myself looking at a losing position for like 2 hours, and I just give myself a headache, and it wasn't healthy.
Yeah, I think during March last year, my garden never looked as good as it's ever been in its life. It's like sunny outside, nice weather, limit down like 10-10, best go do something else. But yeah.
Is this a real garden?
Yeah, I've got a real garden. It grows weeds. It's got dog turds in there, so you clean those up from time to time. It needs a lot of maintenance. Grass grows really long when it rains and it's a bit sunny as well. I just got to shut down the screens and not look. Go find the new stock idea. I've got a watch list of stuff that I keep an eye on that I don't know well, and you just go find a new project. But then if that's just too much of the same, I'll just read books. I'm junkie for the finance books, all the war story ones, or the ones chronicling history as well. You know, the one I'm muddling my way through at the moment still is the Go-Go Years, which is chronicle of the 1960s in Wall Street. So it's quite fascinating when you read this and it's like 60 years ago, and then it's like the same shit today. Environmentalism, racism, too many whites on Wall Street, dodgy practices, pumping IPOs,
Not all the time.
It's changed. It just comes in cycles every 10 to 20 years. And just reading things like that because they're sort of in the field, but they're more like stories of different events. And it's different enough to just get away and distract you from it. Otherwise, just go find other things to do. Watch a bit of NBA during the March crash. So if the garden was done, go watch some NBA, but that was good until COVID killed off professional sports as well. So that's sort of what you do to get away. But there's always a new company to look at for me. Being more fundamentally driven, you can find something that looks all right, you can get stuck into it, and next thing you know, hours have passed and you're not been watching screens, fretting, worrying, or having to think too hard about what you got, and potentially making a mistake by over trading as well.
And you also, like, if you were too reactive during March, or like even any sort of very steep sell-off like that, and you weren't quick enough to pivot, like if people were short, there are a lot of funds and a lot of people that were short into March that did very well, but then were too set and were too like into the screens to pivot once the price had changed and the market had changed, once the Fed just turned on the hose. So you need to have that balance to know when to change as well.
Yeah, I almost walked into getting in a bear trap in late March. So I think it was February, I got absolutely fucking destroyed in the last week. Hosed out a ton of stock early March, had the shorts on, overtraded the shorts as well, because you used to always get these Friday squeezes and then the Mondays were limit down, because during that period it was always markets had a shit week, Friday, close out positions, square up books, and then you get all the bad news on the weekend and everyone just lose their shit again on Monday. So I lost actually quite a lot of alpha by overtrading through the week like that. So you should have been shorting the squeezes into the Monday. But then at that point that Geordie points out, locally, JobKeeper, Europe had its version of JobKeeper, Stimmy in the US, money printing. As soon as bad news was getting a bid, you knew the bottom was probably getting there, because it was different to what happened for the month before, where bad news got absolutely destroyed. Markets got destroyed on bad news. So, and part of that comes by just having people with different mindsets and outlook on markets, because I could have easily persisted through that turn in markets without having more sort of positive people who looked at a different way. So because I am naturally quite a cynical person, it's quite easy to get stuck in bear mode, even after you've had an extreme event like it did. So without them, I probably would have had a terrible April instead of a fantastic April from a performance perspective.
Beauty. Chris, does that answer your question, mate? Chris O, he's bailed.
He gone.
I'm here.
Yeah, is that all right? We having a Tom Hank were?
That was good. I'm just curious what you guys got running in your gardens. No, I've got. I'll send it through later. I've got quite the operation going.
Oh, have you? Okay.
I've got nothing special in mind. My neighbours have got a really good...
Quite the operation.
By operation, do you mean one of my vices, mate?
Yeah.
I'm about to go about tomatoes.
Chris, you're on a bit of land, aren't you?
Yeah.
I've just got a little square to tend to.
No, but seriously, what do you got going?
I've got nothing going. My neighbours grow
some peppers,
all sorts of stuff. So I just normally jump the fence and go pinch all the herbs out of their yard. I got weed.
I'll send you some
grass.
pics of what I got going.
We'll all exchange pics of what we've got going.
Let's move on. Beautiful. Thanks, guys. Thanks for your time. That was good. Very good.
Thanks, Chris.
All right.
See you, Chris. All right. That was Chris O. All right, we're going to add Jonathan on here as a speaker. We'll see what Jonathan has to say. Jonathan, how are you, mate?
Good, guys. Good evening. Hope we're enjoying lockdown.
Yeah, beautiful here.
I'm good. Can you hear me now?
Yeah, gotcha.
Yeah, I just want to get an idea from you guys what you think the next big theme is. We've obviously had, we've had NFTs. We've obviously had lithium if we're talking equities. What are you guys seeing in, equities to start off with, and then obviously beyond that?
Go for it, boys.
My cheeky one is potentially China. And I know that one is very, 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 very spicy. There's a whole lot of bad news getting baked into Chinese stocks that they probably deserve, a lot of them, and a lot of their earnings are likely bullshit. But there is probably some pretty good little nuggets out there that you could pick up for very, very cheap prices at some point. I don't think that's yet, but it's getting there, in my opinion.
Okay. A little bit of spicy China news.
JB, a little bit of Alibaba potentially.
You could buy a Golden Century out of admin.
Buy some Chinese.
You could buy it, the liquidated Golden Century restaurant.
Thanks for your colour, Nick.
No worries.
JB.
I don't have a lot of things right now because there's nothing on the ASX, I think, that presents quite well. You're sort of at this weird spot with the commodity trade. Second half of this year might be quite challenging for it continually, depending on how China shakes out as well, because the Delta wave there really kicks into gear, and depending on whether we ever get told it does in any meaningful way, that could create some disruption before you get the kick in of a lot of the EV spend and stuff that still hasn't, it's coming through, but the big uplift is still backdated by a few years. So I'll just be mindful from a trend reversal perspective to be ready to manage your risk from that. So not so much a bullish one, but a risk management theme to look there. Whether growth scares, uncertainty, maybe the pet rock will start looking more attractive because it's not so much an inflation hedge.
Gold is a good one.
I don't think gold has ever really been the inflation hedge people thought it was. But maybe that uncertainty factor helps that out a bit. But again, you got to really pick your gold stocks, because as you're finding with all the guys who are producing in WA, labour shortages, energy costs coming back, they're getting absolutely fucked at the cost line. So gold price might go up, but if your costs go up as well, then you're just as bad as you were before. So you've got to be very diligent in what you pick and what the catalysts are, and does it have more tailwinds than headwinds? With any of these cyclical and macro trades, you want to be long when tailwinds are more powerful than the headwinds they're still facing, and when the headwinds have the leg up on tailwinds, you want to be out or short. It's just how you got to play cyclicals like that. But in the meantime, because there's no real strong trends, no still strong market direction, this is the beauty of the active fund we have at Capital H, where we just go find stocks where we can jump in and be the value. So things like ARC, where we're sort of building a business from scratch by backing other fund managers, earning equity or buying equity in them, and providing services and helping them grow their fund, and just letting them focus on performance. So, for me, that's a sort of a perk of the job, where you can just focus on a different set of opportunities that aren't theme-driven, macro-driven. But if I execute, or Harley and I execute, and we create our own value and re-rate stocks, and our fund investors benefit immensely from that as well.
I think the issue for the next 6 months is, where are the positives going to come from? Like, the market's already built in every possible positive that could come from people being vaccinated, growth going up, the Fed's doing the maximum amount they can. They're probably going to be doing less in 6 months' time. Like, where is the positive going to come from that makes markets go higher than here, or much higher? They might go another 10%, but you're not, in terms of the balance of probabilities, it's not going to be easy to find stuff that will have a tailwind behind it, because the broader market's it's like maxed right now. So you probably want to look at stuff like gold, because growth is probably going to decelerate from here.
Yeah, inflation rolls off. Maybe it does look more transitory than people believe, and you sort of get this. One view I've had is that's why I've never thought there's been a true super cycle yet in commodities, is you get this big supply side constraints tighten, drive pricing higher. Then you get the demand sort of comes back before a lot of the supply side comes, but you might get that Goldilocks period where it matches again, everything rolls off, growth decelerates after the big initial bounce, but then you kick into some of those key trends. And, if you believe everyone's going to commit long-term to the decarbonisation stuff, that is, akin to the internet in the 90s, maybe it's ambitious, but railroads in the 1800s, there's massive structural investment that comes from there. But that, just because you have these long secular trends, doesn't mean there's disruptions along the way, right? It was only back in 2018 that people were getting absolutely hosed out on their lithium stocks. Secular trend was there. You just had a short-term imbalance. Now they're all the rage again, because that cyclical imbalance went ahead. But in terms of markets overall, as long as markets go up, you got the tailwind, stocks get bid, that's what you want. But you have to be very disciplined with your stock picking when you think markets are going to get choppy, sideways, could even correct. Don't be in stuff where if they've got a raise and the markets are in a bit of a bad way and they don't raise very well or raise at all, and you go to zero. I think just having some sort of defensibility on the balance sheet, the business model, try not to be in stuff that's too pricey. If you're going to have exposure to markets, they're the sort of things you got to keep in mind, and what you still hold through what could be a more challenging period as well.
Yeah, and you have to sort of realize that since 2018, the market hasn't been really buying things or moving on fundamentals. It's been moving on what it thinks the Fed will do next. So you're not, and the cycles have been quite violent. Like you're having like quite short 1 year cycles, and you're having sort of 20, 30% corrections in between. So 2018 end of that, it was 25, 30% sell-off, and the Fed stops hiking rates and starts cutting them, and the market just rams back up in 2019. Then you have COVID. The market's again looking for what the Fed's going to do. Fed just goes absolutely fucking bonkers in 2020. You get another massive ramp back up in the past 2 years. So we've had one of those 1 or 2 year cycles now. What's going to happen next? It's potentially going to be another tough 6 months.
Yeah, no, I don't disagree with that. You just got to make sure you think just in things that aren't at risk of having a soft equity market.
Beauty. Jonathan, how's that sound, mate? Did we get a little bit of an answer to the question?
Yeah, look, it's somewhat bleak, but trade the trades. No, really appreciate it, guys.
Yeah, absolutely.
I think
Awesome.
I think Fletch
Thank you,
might have a
Jonathan.
question, mate.
Mate, I'm trying to put Fletch to bed, so we're at witching hour. I've got a 6-month-old kid, so thanks, Dog Brio.
He just wants his question answered.
Well played. Thank you, Jonathan.
Thanks, Jonathan.
Have a good weekend,
Thanks,
mate.
guys. Cheers.
See you, mate.
Thanks, mate.
All right, we're going to go with Tanzen. Tanzen, add as a speaker. Let's see what Tanzen has to say. Tanzen, you're live. Talk to us. Talk to us now. Talk to us now. Tanzen, we can't hear you. I think you got your mic on mute, maybe? No. I heard something. Hello? All right, Tanzen, I'm going to have to pull you. Unless you can come up with some words. No. All right. Tanzen's gone. Okay. Anyone else? One more question and then we're going to wrap it up, guys. One more question and we're going to wrap it. Oh, Tanzen's back. All right. Add a speaker. Add a speaker. Tanzen, you there? Tanzen, you muted yourself.
Hi, good day, guys. Can you hear me?
Yeah, we gotcha.
Thanks.
Talk to
thanks
us.
so much. Sorry, I got dropped off. I don't know what happened there.
No stress, G.
It was great listening to all of you guys. I have a question for someone who was talking about this Tesla short theme, and I had the question in relation to Tesla's advantage pertaining to the maximum number of autonomous miles driven and the training data. Doesn't that play as a part in terms of differentiation of Tesla in comparison with any other company? Because that's what Kathy from ARK Investing talks about. So I was a bit lost there. So if you can just, talk about that.
Well, you make a good point in that he's very good at marketing Tesla as not a car company and a technology company in terms of the features that he has built into his software. But in the end, it boils down to it. Is he building a software company with software company margins, or is he to look at it from an objective point of view? And the hard part with Tesla is that a lot of holders don't look at it in that point of view. They look at it in a very loved up, and two people that buy that car just become Tesla addicts and buy the stock. It's like a cult. So you need to, it's like me with my Vices portfolio, and that's not, a lot of the companies don't really align with stuff that I think is good or being a good human being, but you need to look at it from an objective point of view and go, how much money is this company going to return me in the long run, and justify how expensive this stock is. And in my opinion, there's no chance. Like, car companies are generally pretty bad businesses to own and be in. So I look at it and go, cool, he has some cool software features that other companies don't have yet. But in the end, he is making and selling a car. And that sort of business should get a certain valuation. And he is just on another planet, like in the same stratosphere as companies like BMW and Volkswagen that have been doing it for 100 years. And it's a very tough business. And to his credit, he's succeeded in it and got a massive valuation for it. But that can only last so long. And eventually money will cost something again. And that will really, really hurt his valuation. I hope that helps.
Oh, absolutely. I think that was really good, because I think what you pointed out too was the expectations of the shareholders and the kind of business and generally the component of the manufacturing and the competitors in the field. So I think that was useful. The only thing that comes to my mind with this is two components. I know that there was talk about Elon Musk importing a lot of industrial machinery to do a lot of autonomous manufacturing as a part of his giga plans. That was one component that comes to my mind with that, i.e., has he been able to succeed with his industrial processes in a manner of smoothing out the issues conventional automakers, sort of come across in terms of manufacturing? And does that help with his manufacturing and margins? One. And second, I also know that his training data or his AI engine for Tesla's autonomous cars is the same data that is the same engine that is used for SpaceX landing, of reusable rockets. So I wonder what you think about those two components in context of that.
I mean, the whole space thing and the software is why he gets it's why he gets the dreamers that buy this stuff, like that buy his stock. But it still comes back to, like, if he's doing it, do you not back Volkswagen or BMW to end up doing it as well? Like, they've got some pretty clever people in those companies that have built cars for a long time. And even if he improves his manufacturing processes to give himself several turns on margin, he's still not even in the stratosphere for other car companies. And something like GM has an amazing autonomous driving that wasn't even in the stratosphere in terms of valuation either. So it just made no sense to me. But it wasn't a stock. It had to be a stock that I waited to go down before I even looked at, because a lot of people that tried to short it on the way up got absolutely fucking destroyed. So you have to wait until the trade starts working to approach it, I guess.
Hey, can I just interject? And I just got a little Elon Musk story just before we move on to the next question. I've got a little Elon Musk story. I just want to share it with everyone because it's a little bit funny. So there's this private bar in Sydney called Level 6. It's at the Ivy. It's like I don't know if anyone's ever been there or heard of it, but it's basically it's just like a really nice bar. All like, high rollers go there, all the professional sports people, really classy bar. You got to pay like a 10K membership, and they actually have a poker table there. And I used to deal the poker game there. And I was working there one Saturday night, and apparently the entire place got booked out by someone for a private party, and it was Elon. He booked the venue out for a private party, and it was pretty funny. He rocks up to the party, not that late either. It was like maybe 10:30, 11. The party started at like maybe 9-ish. So he gets there like 10:30, 11. He's there for like 5 minutes. He's fucking absolutely shit-faced, could barely stand up. He has a couple people like basically holding him up, comes in, does a U-turn, and basically walks straight out, has to go home because he's that fucking drunk. And basically, I don't know what it would have been, like maybe 200K to kind of, oh no, maybe not that much, but like it's a fairly substantial amount to like book the thing out for the night. And he didn't get to even have like one drink in the venue. So that's my little Elon Musk story. And it has nothing to do with trading, but yeah.
I just got a quick question. Does anyone else find it coincidence that on the same day OnlyFans bans sexual content that Elon's dropped a Tesla robot with a feminine styling?
Not coincidence at all. Very well played by Mr. Musk. Tantan, thank you very much for your questions, mate. Have a lovely weekend. I hope that helped. All right, we're going to go with one more question, and then we're going to bugger off, guys, because we've been going for a pretty long time, and I've got things to do. I've got a dog to walk, et cetera, et cetera. So one more question. Here we go. ASX long short. ASX long short. Hit us with the final question of the night, mate. Go for it. ASX long short. Yep, you're muted. Hit it.
Come in. Oh, there we go. So it's more of a comment.
Yeah, there you go.
Based around gratitude.
Beauty.
Firstly, related to JB, he's clearly done very well for himself. And in his intro, he just went hard on self-deprecation, which is unheard of in the funds management industry. So max respect. And then more in general, thanks a lot for putting these on, Sav, and everybody else that has contributed. And then finally, if the Raiders can channel some more Brett Mullins and Ken Nagus in the second half, that'd be nice. Church.
ASX long short. Do you feel comfortable disclosing your first name? If you're not, that's fine.
Mate, just call me No one Druku.
No, I'll tell you what. You DM me so I can say thank you personally.
Yeah, all good, brother. Thanks.
That'd be hectic. I appreciate you coming on. I appreciate you showing some gratitude for myself and these lovely guests here.
Was that a Raiders fan though?
Yeah, exactly. You can tell your Eagles to shut.
No, not a Raiders fan. I've actually tipped the Sea Eagles, but I've got someone chasing me down on a joker and tipping, so he gets double points, and he's tipped the Sea Eagles too. So I'm kind of cheering for the Raiders now.
Oh, that's tough. I've been the last fucking 60 minutes just tearing my hair out here.
Yeah. All right.
Some of that mohair.
I'll have a real question next time. Cheers, boys.
Yeah, beauty. Appreciate it. Thank you, mate. All right, guys. I think we're going to wrap it up there. We've powered through. Josh, JB, G Daddy, Nikki Board Shorts. Appreciate all you guys coming on.
Nicky Board Shorts sounds like he's a gangster from Chicago in the 30s.
That's what I'm saying. That's exactly what I went for. He's got a bit of that about him.
Hey, Nicky Board Shorts.
Hey, Nicky Board Shorts.
Always ready to swim.
He's always ready. Yeah. You go swimming with the.
I was going to say the same thing. Fuck you.
Yeah, he's just got a bit of that slick talking about him. Yeah, boys, enjoy the triple IPAs and have a lovely Friday. And to everybody out there who's fucking spent this time with us, thank you so much for tuning in. Have a lovely weekend. Stay safe, everyone, and we'll catch you next week on Trading Spaces.